Yes. Next is the state finances. Why was in news? Because RBI has released its annual publication titled State Finances. The theme was a study of budgets of 2022-23 with the this is the study of budget 2022-23. However, the theme was capital formation in India, the role of states. State finances in India. Indian Constitution provides the federal basis for governance, and the seventh schedule clearly defines the federal structure between the central and state. The Constitution of India also provides for fiscal institutions and mechanism for intergovernmental transfers to address the vertical and horizontal fiscal imbalances across different levels of the government. But due to the scarcity of capital, nascent private sector, and gaps in implementation capabilities, the state finances revenue and expenses over a specified future period of time have remained weak. That is, the high fiscal deficit, high revenue deficit, and high debt to GDP ratio. So these are the keywords you can remember about the fiscal deficit, that total expenditure minus total receipt. Okay, a revenue deficit means total revenue expenditure minus total revenue receipt, and debt to GDP ratio means the high debt to GDP ratio means the debt of the government is more than its GDP. Okay, so this is the high debt to GDP ratio, you can remember. To overcome his borrowings and debt trap risks, the government introduced the FRBM Act in 2003. FRBM Act, which means Fiscal Responsibility and Budget Management, and this was amended subsequently multiple times due to non-achievement of targets. Here you can see this, the features of Fiscal Responsibility and Budget Management Act 2003. Purpose of this, to establish a financial discipline and introduce transparency in India's fiscal management system, and this sets the targets to reduce government fiscal deficit, revenue deficit, and debt to GDP ratio. These are terms which were mentioned in the Fiscal Responsibility and Budget Management Act. And long-term objective, to achieve fiscal stability and to give the Reserve Bank of India flexibility to deal with inflation in India. And this Fiscal Responsibility and Budget Management Act suggests the bank, the RBI, or the government borrowing from RBI should be or shall be the lender of last resort. Reserve Bank of India should be as lender of last resort for the government borrowing. Okay, and all states have also enacted their FRBM Act under this FRBM Act 2003, and documents mandated by FRBM Act such as Fiscal Policy Strategy Statement, Macroeconomic Framework Statement, Medium Term Fiscal Policy Statement, and Medium Term Expenditure Framework. FRBM targets set by FRBM Review Committee under N.K. Singh Committee, and N.K. Singh is also the 15th Finance Chairman of 15th Finance Commission. Under this committee, the N.K. Singh Committee suggests that fiscal deficit should be 2.5% of GDP by March 31, 2023, A revenue deficit would be 0.8% of GDP by March 31, 2023, and debt to GDP ratio 60%, 40% limit for center and 20% limit for states. So you can remember these are the facts, very important for prelims as well as means perspective. So you can remember again, a fiscal deficit should be 2.5% of GDP by March 31, 2023, which is ended. Revenue deficit. These are three basic features: fiscal deficit, revenue deficit, and debt to GDP ratio. Fiscal deficit 2.5% by March 31, 2023. Revenue deficit 0.8% of GDP by March 31, 2023. Debt to GDP ratio 60% should be clear, and 40% limit for central government and 20% for state government. So you can remember this. This is gross fiscal deficit, that is total expenditure minus total revenue receipt. Revenue receipt means revenue receipt plus non-debt capital receipts. State's debt is budgeted to ease to 29.5% of GDP in 2022-23 as against 31.1% in 2020-21. Although improved, but it is still higher than 20% as recommended by FRBM Review Committee. 38% higher budgeted capital outlay from states in 2022-23 after a robust growth of 31.7%. These are too much data which you need not remember all this data, okay, and this shall definitely you can remember these data about fiscal deficit, revenue deficit, debt to GDP ratio, which were recommended by the FRBM Act under Encasing Committee. Accordingly, states capital outlay GDP ratio is budgeted to increase 2.9% in 2022-23 from 2.3 in 2021-22 provisional accounts or PA. Okay, and the significance of strong state finances such as achieve growth with 60% of general government expenditure incurred by states. State finances become vital in India's macroeconomic policies because the important for faster recovery amid ongoing impact of pandemic and geopolitical tensions, and attract investments. Lower fiscal deficit and state debt eases the pressure on interest rates and thereby increases investments. It can also help in improvement of India's sovereign credit rating from rating agencies because of better macroeconomic stability. Employment generation. Strong finances can improve the quality of public expenditure, that is, increased capital expenditure, helping in additional demand creation and employment. Also, the state government employs 5 times more people than the center. Okay, so this is about the welfare of the people, because if the finance should go to the with the hands of state government, so state government will spend money on its people, on its citizens, and this finance should be shared by central government with the state government. Achieve sustainable development goals with a focus on infrastructure, research and development, health, education and other social services. It becomes important as key areas such as public health, sanitation, agriculture, irrigation, etc. comes under the state list due to their proximity to the local issues. Existing concerns over state finance. Vertical imbalance. These are the existing concerns over state finance. In vertical imbalance and horizontal imbalance, the dominance of committee expenditures, okay, and centers influence flattish or modest growth of states or tax revenue and lower on non-tax revenues and possible moderation in tax buoyancy. So these are the some concerns regarding the state finances. In vertical imbalance, high dependence of states on center for resources as the resource mobilization powers assigned to them falls short of their expenditure responsibilities. In the last few years, the tax devolution from center to states has been affected because the more centralized power with the central government and it don't want to share the power with the state due to growing cesses and surcharges percentage in gross tax revenue. You can remember these cess and surcharges. Cess is collected for the specific purposes, okay, specific purpose, and frequently surcharges frequently taxed on the goods and services, and this is regularly taxed, surcharge regularly taxed, whereas the cess charged with the specific purpose, okay, when the specific purpose is ended, this cess cannot be charged from the people or from the corporate, okay. Cess and surcharge revenue is estimated to reach 24% in 2020-21 from 10 to 15% of gross tax revenue during 2011-12, 11 to 20. The share of untied funds, tax devolution plus revenue deficit grants in central transfers to states has declined from 32.4% during 2015-20 to 29.5% of the center's gross revenue receipts for 2021-26 according to 15th Finance Commission. And under horizontal imbalances such as devolution among the states and variations within states, ability to resource mobilization and expenditures due to region specific disparities and diverse socio-economic structure and populist fiscal measures such as non-levy of certain taxes or state specific expenditure schemes also contribute to it, and dominance of committed expenditures in the expenditure patterns of states such as interest payments, pension and administrative services. So you can remember the center's influence on expenditure policies of state due to centrally sponsored schemes and flattish or modest growth of states on tax revenue due to issues such as inaccurate forecasts, high administrative costs, lack of innovation, economic shocks, etc. and lower on non-tax revenues or returns of capital investments due to losses of state PSUs, lack of proper user charges, and possible moderation in tax buoyancy, that is responsiveness of tax revenue growth to changes in GDP. How you can tackle these problems or these concerns? The growing threats of global recession, high inflation, job losses, etc. demands major reforms to continuously improve state finances and achieve long-term targets through logistic reforms. Overhaul the FRBM Act based on the legislative reforms. The legislative reforms overhaul the or overpower the FRBM Act based on the recommendations of the 15th Finance Commission and FRBM Review Committee for greater transparency and debt sustainability. The 15th Finance Commission recommended a fiscal deficit limit as percentage of GDP of 4% for states in 2021-22 and 3.5% in 2022-23 and 3% during 2023-26. So you can remember these data about the fiscal deficit limit by the 15th Finance Commission. Initial the 4% for 2021-22, 3.5% for 2022-23. These are the chronological order, whereas 3% during the 3 year, that is from 2022 to 2026. The FRBM Review Committee recommended to replace FRBM with debt management and fiscal responsibility. So you can remember also this, okay. The 15th Finance Commission recommended to replace FRBM with debt management and fiscal responsibility with public debt to GDP ratio, okay, as a medium term anchor for fiscal policy in India, and creation of a fiscal council to prepare multi-year forecasts, recommend changes to the fiscal strategy, etc., and rule based policy framework with clear grounds of deviations from the target for transparency and predictability. Fiscal reforms. The states must prioritize debt consolidation as part of fiscal policies with proper standards on reporting of public debt and contingent liabilities and their risks, targeting double-digit growth in SOTR. For example, state excise, stamp duties and registrations, taxes on liquor sales and state GST, etc., to stabilize state budgets and economic planning. Institutional reforms. Timely setup of state finance commissions to decide on the assignment of taxes, fees and other revenues to local governments, and strengthen the third tier of the government by increasing the functional autonomy of local bodies. Expenditure reforms. Increase public expenditure for capital formation and productive assets, that is expenditure on R&D, education, health, green energy transition such as renewable energy, etc., to spur innovation and progress. Improve fiscal health of state PSUs, increase revenues from state assets, address upcoming challenges of recession, climate change, etc., and other measures such as continued ease of doing business to create a congenial environment for the private sector to invest and thrive, and encourage and facilitate higher interstate trade and businesses to realize the full benefit of spillover effects of state capital expenditure across the country. So you can remember this capital expenditure. Shortly you can write the capex, means full form is capital expenditure. Next is the microfinance sector. Why was in news? A joint study from Price Waterhouse Coopers and the Association of Microfinance Institutions of India has highlighted leading role of microfinance institutions in India's economic growth. India's microfinance sector and microfinance institutions. What is microfinance? It is a form of financial service which provides small loans and other financial services to poor and low income households, such as in the lower town. In the small town there were more number of chit funds opened there, and the people of the town recommended loans from these chit funds. Okay, these microfinancial sectors. And also the people borrow money from these microfinance financial institutions, and this poor and low income households. This section of society is also known as missing middle. So you can remember this term missing middle, such as the small loans and other financial services to poor and low income households. Poor and low income households are also known as missing middle, lacking access to formal credit for want of a collateral support. Okay, and here you can see the microfinance sector in India. Market share up to September 2022. Banks capture these microfinance more than 40%. Non-bank financial companies, microfinancial institutions capture more than 30%. Small finance banks more than 18%, and non-bank financial companies is more than 8%. And these are the non-profit microfinance institutions. Less than 1% capture these microfinance institutions. And prevalent disbursement models from self-help groups and joint leading groups. Underlying strategy, scalability, average group size, associated non-performing assets, future landscape. So these are the parameters for this prevalence disbursement model of microfinance institutions. Importance of microfinance institutions: promotes inclusive growth by providing collateral free credit to over 6 crore borrowers at the bottom of the economic myriad or economic problems. And poverty alleviation by supporting the income generating activities through short tenure loans. Women empowerment, as a vast majority of users of microfinance facilities are women, and social equity, as microfinance institutions are actively involved in financing of water sanitation products and services. Awareness on government schemes such as Ayushman Bharat program and PM Swanidhi. Street vendor, this is Swanidhi scheme for street vendors. Okay, and this street vendor, the full form of this Swanidhi scheme is Street Vendor Assurance for Nidhi. Okay, financial inclusion, as microfinance institutions offer a number of other financial services as well. For example, savings, insurance and remittance along with credit, and promote entrepreneurship through extension of non-financial services such as counseling, training and business support. It provides a huge impetus to the unorganized sector by promoting employment generation. This is Nobel laureate Muhammad Yunus is credited with laying the foundation of the modern microfinance institutions through establishment of Grameen Bank in Bangladesh in 1976. So you can remember the name of Muhammad Yunus, who was the Nobel laureate from Bangladesh, and why you can tackle these some challenges, including the microfinance institutions which improve which can improve in the country. To achieve sustainable growth, the future course of the government, regulators, industry, etc. should work upon the bridging the inherent regulatory gaps through statutory regulatory framework, are common definitions and a standardized lending risk management and control model, and opening new investment channels, especially for small microfinance institutions who source majority of their debt funding from other financial institutions, reducing their exposure to external factors, and forging partnerships with corporate impact investment and exploration of new and reliable business models of capital generation can help in it, and creation of a robust micro lending landscape to the poor and marginalized section through a strong monitoring mechanism, that is, when microfinance institutions finance through borrowing by the people, and these microfinance institutions can frame the strong monitoring mechanism, that is, compulsory registration of all existing non-governmental organization microfinance institutions, and prudential accounting norms on capital adequacy and provisioning, specifying the role of auditors and supervision of microfinance institutions, promoting interagency coordination, creating councils and committees at central, state, and district level to monitor the sector, leveraging technology in developing new products by identifying the prospective needs of borrowers. For example, analytics based underwriting and collection models can be used, and developing a fair practices code for transparency and customer protection, that is, transparency, avoiding ill practices such as multiple lending, over borrowing, and customer harassment through coercive methods of recovery. And micro lending happens when a borrower takes out overlapping loans from multiple lenders. Establishment of a suitable grievance redressal mechanism, and capacity building of microfinance institutions through handholding in formative stage, transformation loan to scale up, and creation of a risk development fund managed by RBI for loans to underserved regions, refinance or investment to microfinance institutions, encouraging microfinance institutions to set up local area banks or floating of local area banks by commercial banks can be explored. Okay, so you can remember about this, about these microfinance institutions. These are the regulatory, borrowers, operational mechanisms under the banks. Okay, regulatory model of microfinance institutions. Except the RBI regulated entities, other microfinance institutions have minimal or no regulation, no facility to ensure consumer deposits, misuse of market dominance by charging excessive rates, strategic and credit risks. And here, borrowers, those borrowers, a lack of formal credit history, absence of collateral, laborious customer acquisition process, low financial literacy. So these are the borrowers under microfinance institutions. And operational coercive recovery processes of microfinance institutions, multiple lending practices by some finance institutions, and diverse nature of customer segments, for example, small farmers, vendors, and laborers, making it difficult to offer customer centric products based on occupation behavior, and technological risks around customer data protection and data privacy, and low digital literacy leading to dependence on physical modes to reach remote borrowers, and financial, these are limited access to low cost funding for microfinance institutions, high interest rates, dependence on commercial banks for loans, over indebtedness of microfinance institutions, and profit-seeking approach by some microfinance institutions, etc. So these are the some challenges related to the microfinance institutions sectors. Next is the Insolvency and Bankruptcy Code, that is IBC. Why was in news? This IBC is frequently happening in news because the more resolution cases are resolved by the Ministry of Corporate Affairs in the corporate sector. To strengthen the functioning of the Insolvency and Bankruptcy Code, the Ministry of Corporate Affairs has released proposed changes to Insolvency and Bankruptcy Code for public comments. Here, these are the terms related to insolvency and bankruptcy. Insolvency is what? To a situation where companies or individuals are not able to repay the debts they owe, and they are called as insolvency. And bankruptcy means it is a legal proceeding initiated when an individual or entity is unable to repay outstanding debts or obligations rather than the paying money earlier than the pay to the whole money to the banks. Okay, so this is the bankruptcy and this is the insolvency. So you can remember these terms related to insolvency and bankruptcy code. And features of bankruptcy code. The IBC in force since 2016. IBC is India's comprehensive law for a time-bound market mechanism to address the insolvency of corporate persons, partnership firms and individuals. And this IBC creates a single law for insolvency and bankruptcy for a robust, modern, sophisticated insolvency framework. IBC is based on 4 pillars. Which are 4 pillars? The Insolvency Professionals, Insolvency and Bankruptcy Board of India, Adjudicating Authority, and last is the National Company Law Appellate Tribunal. Okay, so these are the 4 pillars. Under Insolvency Professionals, member of Insolvency Professional Agency to carry out the resolution process. Information utilities, that is IUs, to store details on lenders, lending terms, etc. in an electronic database to facilitate insolvency resolution, that is, for example, National E-Governance Services Limited. The Insolvency and Bankruptcy Board of India to regulate functioning of IPs, IPAs and IUs. Okay, so these are the 3 pillars, and this is Insolvency and Bankruptcy Board of India. And last is Adjudicating Authority, that is National Company Law Appellate Tribunal and Debt Recovery Tribunal. National Company Law Tribunal adjudicates insolvency resolution for companies, while Debt Recovery Tribunal adjudicates for individuals. So you can remember the difference between National Company Law Tribunal and Debt Recovery Tribunal. National Company Law Tribunal is for companies to resolve the case, and Debt Recovery Tribunal is for the individuals to resolve the cases of individual is involved. And National Company Law Appellate Tribunal is the appellate authority for hearing appeals against the orders passed by the National Company Law Tribunal. Based on the assets value and debtor type, IBC provides for different corporate insolvency resolution processes as corporate insolvency resolution process, pre-packaged insolvency resolution process, and fast-track corporate insolvency resolution process. Refer image. So these are the three pillars of the assets value and debtor type. Based on these value and type of assets. Okay, so here you can know the more other terms such as insolvency professionals. Why insolvency professionals? These are enrolled with an insolvency professional agency and are involved in dissolution process of an insolvent. So these are the members of the Insolvency and Bankruptcy Board of India. These professionals are authorized to act on behalf of the such insolvent individual, companies, etc. Insolvency Professional Agency IPA is frontline regulator that enroll and regulate the members practicing as an insolvency professional in accordance with IBC 2016. Insolvency Professional Agency is also responsible for capacity building of insolvency professional. Bad loan resolution. Insolvency and Bankruptcy Board of India regulator, information utilities, adjudicating authority, National Company Law Tribunal or Debt Recovery Tribunal, and insolvency professionals under oversight of Insolvency Professional Agency. These are the insolvency and bankruptcy code under these four pillars of this IBC. Okay, and how insolvency and bankruptcy code benefit to the government as well as the corporate sector. Economic stability and growth. Insolvency bankruptcy code ensures this by overhauling the corporate distress resolution regime of India through a time-bound process with a creditor in control model. Maximize the value of distressed assets by reducing the time taken and cost of bankruptcy resolution. By end of September 2022, out of total 5,893 CIRPs, about 36% were resolved and 30% were liquidated. Thus, as they ended this case or freezed these cases. Also, the average time taken for resolution has decreased from 4.3 years in 2017 to 650 days in 2021-22. Okay, and these IBCs promote entrepreneurship, as IBC is an important reform towards ease of doing business and maintain healthy credit flow by ensuring that credit does not get struck or turn into bad loans through time-bound resolution. Balance the interests of all the stakeholders through profound change in creditor-debtor relationship and alteration in the order of priority of payment of government dues. Okay, so you can remember these important terms for the prelims examination and issues in its implementation. Adjudicating delays. Study increase in the time taken for admission of resolution application as well as the final resolution and liquidation. For example, 64% of ongoing CIRPs have crossed the 270 days limit because of unfilled vacancies at tribunals, failure to adhere with timelines, and litigation at appellate authority under National Company Law Appellate Tribunal and Supreme Courts, and low recovery rates, declining rates of recovery with higher haircuts. That is the amount of debt that banks forgo. Haircut means the amount of the finance cut by the government and provided it to the authorized person. For example, in financial year 2022, for 100 out of 500 companies that saw proper resolutions under IBC, the haircuts were above 90%. The reduced market appetite for insolvent firms due to pandemic has further added to asset value erosion. And cross-border insolvency. IBC lacks a standardized cross-border insolvency as observed in Videocon and Jet Airways case, upholding home buyers' rights. Though home buyers are recognized as financial creditors, Chitra Sharma versus Union of India, it requires a maximum threshold of 10% or 100 home buyers, whichever is lower, of one project to initiate the process, causing practical difficulties in meeting the required threshold to initiate insolvency proceedings against the real estate owner. Low utilization of insolvency units. Despite its vital role in limiting the insolvency resolution time period, it is the least utilized pillar of insolvency and bankruptcy code. Issues in functioning of insolvency professionals and insolvency professional agencies. Multiple insolvency professional agencies regulating insolvency professionals lead to various issues such as absence of common standards, non-uniformity in decision making, lack of due diligence in maintenance of claimants record, etc. So these are the some issues and challenges about insolvency professional insolvency bankruptcy code. And key changes proposed in the insolvency bankruptcy code framework and its benefits. Under technology and proposed changes, developing an e-platform to handle multiple processes under insolvency bankruptcy code, such as case management, delivery of notices, storage of records of CDs undergoing the process, etc. And potential benefits: transparency, reduced delays, better decision making. Okay, and admission of CIRP applications. Financial creditors to ascertain default or dispute occurrence at information utilities before CIRP application. Adjudicating authority to mandatorily admit application and initiate CIRP if default is established, and delete certificate of deposit right to propose an interim resolution professional and give it to the adjudicating authority. IPR will be appointed by adjudicating authority on IBBI recommendation. So these are the some terms related to the IBC which you can remember this. And reverse CIRP allows promoters to refuse funds into start projects for resolution. And why you can resolve these cases, and you can suggest to further refine the insolvency and bankruptcy code process, because this IBC is very important for economic point of view. Okay, so you can remember thoroughly about this IBC process. And what are the solutions? Filling up of vacancies and setting up of more benches or specialized benches of National Company Law Tribunal. Setting a benchmark for the quantum of haircuts allowed as per global standards, or giving leeway to banks in taking haircuts without inviting enforcement agencies persecution. Adopting the United Nations Commission on International Trade Law. Adopting the United Nations Commission on International Trade Law. model law on cross-border insolvency with certain modifications to suit nation context, and formulating a professional code for the code on code who take over a company in distress, an establishment of a single professional self-regulatory insolvency professional agencies like the Institute of Chartered Accountants of India to set standards and regulate the functioning of insolvency professionals. So this is all about the insolvency and bankruptcy code. So you can remember, because it is very important for prelims as well as mains perspective. Okay, so here we will end this lecture number 4, and next we'll revised from loan loss provisions. Okay, that is LLPS. So keep watching, like the video and subscribe channels, and hit the bell icon because you cannot miss any update of these current affairs. And you can watch, if you have the anthropology in your optional subject, then you can watch the anthropological lecture, which is very important for your optional subject in 2024-25, because here current affairs thoroughly are discussing. Okay, so be happy and watching the video, and have a good day.